The moment a company launches the IPO on a stock exchange, is that the time that I, as an investor, go in and buy shares? Is that the moment? Is that the magic moment?
I think it really depends, right? If there's such a magic formula, wow, this is a for sure winning, opportunities, everybody will be jumping into the
That's
IPO,
true.
right?
Hey there, so I'm going to read you a list of companies, and I want you to figure out what they all have in common. Are you ready? Reddit, Mixue, Grab. Have you figured it out? It's okay, I'll spare you the Googling. These are just a handful of companies that have gone public in recent years. Now, when a company decides to go public, it lists an IPO, an initial public offering, on a stock exchange. But what does going public actually mean in the business world? And why do they decide to go public? When do they decide to do it? And more importantly, when should I buy in to this newly listed company? Hello there, I'm Andrea Heng, and this is Money Talks Explains, where we have a burning question and we get an expert to break it all down for us. So, let's get an explanation now from Professor Zhang Weina, Associate Professor of Finance at NUS Business School. Welcome.
Hello.
Hi.
Thank you for inviting me.
It is so good to have you here because this is a question that's come up a lot among my peers, including myself. So is it fair to say that when a company goes public, it's essentially laying everything bare for all to see?
I think more or less that is true.
Okay.
Yeah. So when a company go into the public listed market and everything will become transparent, they have to comply to the regulations and they also have to declare their financial statements to the public and they also have to implement good corporate governance.
Why though? Why is being transparent? Why is seeking transparency, seeking to be transparent so important for a company?
I think that many times the companies decided to go to public for slightly different reasons.
Okay.
Yeah. The first reason is probably the company want to raise more capital to expand their businesses. So they want to have access to the public capital markets. But on the other hand, companies may also want to access to a broader base of investors.
Okay.
Because before the IPOs, the companies usually will raise the funding through the private capital markets.
Got it.
So now going to the public, they can raise the capital from a diverse group of investors, including institutional investors as well as retail investors. So because of this access to the greater capital markets, they have to be transparent and accountable to the public.
So on average, how long does it take after a company is formed before they decide, okay, let's go public?
It really depends. Some companies may take many, many years to reach there. Some companies can reach to the IPO stage within 10 years.
Okay.
So it really depends on what is the company's business model and whether they think that accessing to the capital markets is very important for them.
Okay. So when a company goes public, it lists an IPO on a stock exchange. A few questions here, but the most basic, Professor, is what exactly is an IPO, an initial public offering?
The IPO basically describe the company going to, issue new shares for the public to purchase. So this is the most conventional IPO process. So that means on the day of listing, and everybody in the public will be able to transact these new shares.
Okay.
But there are also some companies go to the public listing without actually issuing new shares.
Okay.
So this is what we call direct listing. It is less common, but the company that has done so recently, like Spotify. So these kind of companies, they may not need additional capital from the public because they already get a lot of funding. Their business models are very attractive to private investors. So then you ask the question, why do they want to get listed?
Exactly,
right?
yeah.
So these companies, basically, they would like to provide liquidity to the existing shareholders.
Okay.
So that means you are holding a private company shares before you go for this direct listing.
Right.
And now, because the company is listed on exchange, then you can basically sell off your shares.
So it's just to offer the opportunity for investors
For the existing shareholders to liquidate their positions. And sometimes, these kind of companies also give the shares to their employees. So their employees can also cash out the investment. But, the difference between the IPO and the direct listing is that the direct listing does not really require a lot of capital injection at this moment.
Okay.
But they still want to come to the public domain because in the future that they may need capital injection, then it's easier to do so. And then it is also increasing the company's reputation and credibility.
Are there other ways for companies to go public besides listing on the stock exchange? Or
Yeah, there are at least the two other types.
Okay.
One is called reverse merger and the other one is called SPACs.
Oh, okay. Tell me more.
So the reverse merger is basically a private company seeking to be listed through a public entity. But this public entity is already listed, but it has minimum operations.
Right.
But it is still active on the stock exchange. So therefore, this private company would like to have a quicker access to the public market through this reverse merger.
Okay. And a SPAC was the other one you mentioned. And if I'm not wrong, the Grab listing on NASDAQ was through a SPAC. Can you explain to our listeners what a SPAC is?
Okay. SPACs basically means that this public listed company is created for the purpose of being a shell, such that the private companies can actually get merged, then they can become public listed.
I see.
Yeah.
So how does a company decide whether to go via a reverse merger or a SPAC?
I think it depends on who are the shell company. So they have to basically go through the market searching and to see that whether it is more suitable through the SPACs, because the SPACs has to exist in the first place.
Yes.
And SPACs usually is basically listed through some kind of investment companies. So they do not really have their own business operations.
I see.
While in the reverse merger, the companies may used to have operations, but now it's minimum.
I see.
And it's still listed on the public.
Okay. So there are various advantages and disadvantages to either option, obviously, depending on what the company wants to do, right?
Yeah.
When a company announces, we're going to go an IPO on a stock exchange, very often the discussion is about what the share price is, essentially. How is this IPO price determined? I mean, who is doing the math behind the scenes? Is someone, tapping on the calculator in the office somewhere?
Definitely.
Okay.
Definitely. There's a whole team of investment bankers behind the entire listing process.
Okay.
Yeah. So let's go back to the traditional one, the IPO process. Usually you will engage investment banker to do the evaluation. So basically the company will surrender all the financial statements, the past records, and also the plan for the future business development. Because a lot of this pricing also depend on what the companies decides to do after they become publicly listed. So there will be a lot of number crunching, right? Especially towards the very end of it. You need to have a final dollar and cents price to be released to the public, right? So a lot of the analysts will not be able to sleep in the last few weeks of this evaluation process.
It's a lot of pressure, right?
It's a lot of pressure, and then you also have to decide whether this is good price. So there's a lot of parties involved in determining the price.
So the moment a company launches the IPO on a stock exchange, is that the time that I, as an investor, go in and buy shares? Is that the moment? Is that the magic moment?
I think it really depends, right? If there's such a magic formula, this is for sure winning, opportunities, everybody will be jumping into the
That's
IPO,
true.
right?
Yeah.
But the reality is not necessarily so clear cut. Okay, so I can give you examples of companies that are not doing well after the IPO, and there are also companies who are doing well after the IPO, right? So it really boils down to a few elements. So basically, we understand that the companies moving from private domain to the public domain, they may have limited track record.
Yes.
Yeah. So when you are doing the analysis, maybe you only have a few years of data that the company has disclosed. Unlike the existing public companies, they have been around for many decades. You can always track how the companies have been doing in the past, in the economic upturns and the downturns, how they, basically go through the different types of episodes.
Yeah.
And secondly, during the IPO window, right, there's a lot of hypes
Yes.
So people will be talking about the companies, and there will probably also be emotion involved, right?
Yes.
And there are a lot of institutional investors will also be, giving their opinions, right? So it's not just the investment bank that is listing the stocks, but it can also be other institutional investors also want to buy into these companies.
Sure.
So there's a lot of facts going on around the IPO days. So sometimes this can be good. Okay, you can see that the share price rally a lot on the first day. But you may also see that some stocks actually drop the price on the first day of trading.
Yes.
So there's a lot of emotions. So for people who are less risk-loving, then they may find that this is very volatile, that they may not be able to cope with the price run up. And the other thing I want to bring to the attention is that there is usually a lockup period for the IPO.
Oh.
So that means the people who used to hold the shares of the companies before they actually float to the public, they will have a lockup period. That means they cannot sell the shares within this lockup period.
Okay.
So it can be 3 months, it can be 6 months, it can be 9 months. So then after this period, then the insiders or the employees or the private investor used to hold the shares will start probably sell their shares, and that is where that you probably will see like a share price get a little bit deep down, right? Because you have the supply, you have the more supply of the stocks. For people who really believe in the company, did your fundamental analysis, I think that it's okay to trade on the IPO day.
If you can
hopefully, right, you can bid for the low price. But for those people who want to wait a little bit more to understand the company business model a bit better, right, then you probably want to start to buying a little bit later. So probably after 3 to 6 months, when you know that the lockup period has expired, those insiders, those employees have already kind of like traded their public listed shares, then, it can be also a good time to go in.
How does a company decide which stock exchange to list on? Because when Grab listed on the NASDAQ, it came as a surprise to a lot of Singaporeans because, hey, this is a Singapore company. Why is it not listing on the SGX? So how does a company go about choosing which stock exchange to list on and why?
I think this is another very important strategic decision the company has to make. And to them, right, there are a few considerations. The first is about the investor base. So, where you choose to list, depending on how big, the public market is, right? So if you want to get a bigger access to the capital markets, you probably want to go to the bigger exchange, right? The second thing that I think the company also would like to consider is basically the company's reputation, how they will be viewed by this broader investor base. So that means if the company thinking more globally, probably they want to go to a more international wise exchange. But for the companies maybe want to focus in Greater China or the Asia business, maybe they want to go to a prominent exchange in Asia. So I think that the Grab's decision basically revealed to us that Grab has, this kind of a global vision about their businesses, activities. I think that is one of the key reasons they choose to list on NASDAQ. But the company also mentioned that they will possibly consider that, also doing a second listing, in Asia, right? But that one has not come to the decision yet.
So a company can list in 2 different stock exchanges.
Exactly. But it's not like you just have more access to more investors. There's also a cost to be paid.
Sure,
right?
Of course.
So Alibaba has chosen to list on New York Stock Exchange and then later on also on Hong Kong Stock Exchange.
Right.
Then this company has basically to comply to both exchange regulations.
Yes.
And that means you are more scrutinized by the regulators. But then you also have probably the due access to the different investor base, because we know the Hong Kong trading hours are different from the New York trading hours.
Correct.
So basically day and night, your stocks will always be watched over, always being traded and so on.
How does an investor here in Singapore access companies listed on the various stock exchanges?
So the most common way is through the brokerage house.
Okay.
So basically, you need to open a brokerage account with some of these trading platforms. DBS have Vickers platform. OCBC has its trading platform. So basically, you open an account, then you will be able to trade through those brokerage accounts. And thanks to the fintech, now you have a direct trading platform such as Moomoo, right? So a lot of the young investors now just create an account and then they link up their bank account, transfer the money in and out, then they can trade. Yes.
To do it now.
Getting a little bit worried, right? Whether they have enough knowledge before they open the trading account.
You brought up a very, very good point.
Because it's so easy to access to different exchange through these trading platforms.
What are some barriers for companies looking to launch an IPO? Because we understand that delays can happen, right? For various reasons. So what are some of those barriers to companies going ahead and deciding to launch an IPO?
I think that there are a few barriers that the company need to be prepared. The first one is basically the regulatory requirement. So when you're going through the listing, the exchange will ask you to submit all the documents that according to their regulation. So if they find that some of these documents are not in a place, you have to collect further information. You have to get an auditor to audit a certain part of these statements. Then you have to go through that process. Okay. And secondly, I think it's also about the book building. Okay, so book building is usually depend on the investment bankers, right? They are going to go through all this roadshow, we call roadshow. So they will tell the public, okay, this company plan to get listed and this is the amount of the capital that they want to raise. Then they will ask the people, whether they want to put their money into this IPO. Okay. So this is called book building.
Right.
So the investment bankers will not decide to go ahead if they don't see that there's not enough demand for this company's stocks.
Okay. So there has to be demand on the ground as part of the research.
And the roadshows are the ways to determine that.
You really are rallying almost, right, for support.
So during those kind of talks, right, the company managers will be there to explain the business models and the investment bankers will give their, views and evaluation and the projections.
Wow, it's a lot of hard work.
Yes. It is a lot of hard work. Yes. So the book building really determines that how strong the market demand is. Yes. And if you think that it's not strong enough, right, then they will say, okay, let's pause and to work on some of these things again.
So at the end of all of this, you also know about companies that delist. So what happens when a company delists? What happens to my shares when a company delists?
If the company go through the delisting and for the reason of from moving from public firms to the private firms, they will usually let the shareholders have the time period to redeem their shares at a certain prescribed price.
So it's pretty simple.
Yes. But if the company is getting delisted because the companies are not doing well, that is a different issue, right? Yeah. So the companies will go through like bankruptcy process and then they will actually set the priorities, how to liquidate the assets of the company. And then usually they will pay off the debt holders first before the equity holders. Due to the financial challenges, the shareholders may not get much.
Okay. Consider IPOs explained. Professor, thank you so much. This was the lesson we all needed on IPOs. So thank you for doing this for us. And thank you for being our Money Talks explainer.
Thank you. Thank you for inviting me here.
The pleasure is all ours. We hope that explains IPOs to you. If you have a finance thing that you want explained, write into us. All you have to do is send us an email, cnapodcasts, plural, @mediacorp.com.sg. This has been Money Talks Explains. I'm Andrea Hing.